for Raj, something that would be important would be to think like a business person, not just a real estate investor. You know, obviously we're all very involved in the real estate space, but you need to put on your entrepreneur's hat. You need to put on your business owner hat and say, okay, is this the highest and best use of my money or my time, depending on how much time or how much money you've spent on that deal? What is it returning me? Am I happy with that return?
Okay, welcome back. This is Real Estate Investment Club, and this is another webinar on Wednesday. As usual, we invite people, guests, to come over and give us their stories and the skills and the things we need to learn. The goal of this webinar here is always to help you to move from what we call a speculator and move you to savvy investor, and that would help you to choose the right property. So that would, if you're not a savvy investor, any news can blow you to right or left, and that's not the way it should be. The goal here is to give you a roadmap. Actually, you have to make your own roadmap, but that's the best foundation for all of us. Now, usually I go to the housing market for Toronto. What's happened last few weeks or 1 month in terms of investment? What part of Toronto is the best place to invest? But today we have a special guest, and I'm going to use this time for him to tell us a little bit of his story. So the title is Finding Hidden Opportunity, Identify Highest and Best Use. And I have Ryan Carr with us. He's a full-time real estate investor in Durham region, and he's specializing in helping the homeowners to get the solution that Ryan has for them. And Ryan has developed a great skills in handling this kind of property. And I'm going to help facilitate this conversation we're going to have. Ryan was in Boomerang, Global News, News Talk 1010, BNN, and Real Estate World magazine. I have his phone number down there. He's also the author of the highest and best use playbook. Ryan, is it out or not yet?
It's coming out spring market 2021.
Okay, and without further ado, I have Ryan. And Ryan, you want to take over your screen? Okay, it's all yours.
Oh, mine. Okay, cool. So thanks for having me on. Really appreciate you doing this. My name is Ryan Carr. Quick intro. I've been investing full-time since 2012, on and off since 2014. On and off since 2012, full-time since 2014. And since then, I've completed about 50 some odd transactions in the GTA markets. I typically focus in the Durham region and east, so I like to run up the 401 corridor. And with that, lately, we've been focusing on quite a few things. I got my finger in a couple different niches of the market. So I'm focusing on infill developments. I'm focusing on flips, focusing on basement apartments and 2-unit conversions, family development as well. I'm writing a book. We talked a little bit about that. It's called The Highest Best Use Playbook. That's coming out spring market 2021. And it's really helped me identify a lot of the different ways that I've been able to be successful in the previous markets or the previous years from then till today.
Excellent. So you started around 2014, you said, right?
I did, yeah. I started in 2012, part-time.
Where are you coming from? What is your background, and why you started real estate investment?
Yeah, I grew up in Markham, which is just north of Toronto, obviously, and I had no real estate background, zero. So I was a mechanic. I was fixing cars full-time, building armored vehicles as well, which is a really neat career path for a few years. And then from there, I got laid off. It was a bit of an unfortunate thing, but I got laid off, and so did about 30 other people that were in this business. And I'd flipped a couple houses with my wife in the meantime, and she was like, you know what, you're pretty good at that. Why don't you just continue real estate? So that's what I did in 2014, went out full time, and haven't looked back since then.
So Ryan, why instead of looking for another job in your career, you decided to turn your face all the way to real estate investment? Sounds dangerous for so many people. And you said, okay, let's do it. It was like you woke up in the morning and said, okay, it's time for me to invest in real estate.
Pretty kind of sort of. So when I did our first couple of properties, the margins were good. We made some really good money. And my wife was like, well, you enjoyed it. You're good at it. Why don't you continue doing that? And so she was really the catalyst for me to push forward and say, okay, no more full-time job. Let's not go back to that 9-to-5 mentality. Let's go and do the self-employed thing. We'll try it. If it doesn't work out, I mean, you could always go and get another job. But if it does work out, then you'll be way more happy. So that's what I tried, and here we are.
Great. And tell us about your very, very, very first project.
This project was a bank sale fixer-upper in Oshawa. Bought this property against the advice of pretty much everybody. Everybody said, don't do it, too much work. And I said, we want a project. This particular place came with some land as well and a detached garage. So I said, hey, let's fix this thing up. And we ended up making out quite well on it. Over the next couple of years, we fixed it, and that gave us some seed capital for the future projects to follow.
Excellent. A very typical question here is, let's say one of the investors find a place. How do they know, and put yourself in their place, how do they know this is the right property?
Ooh, okay. So deal evaluation is such a critical point. So, your slide at the beginning, becoming a savvy investor, that's really what it's all about, is understanding how to analyze a deal. So for me, I realized quite quickly that the money was in the buy, not in the sell. And the renovations are sort of just a means to an end to get you to there. So for me, I'm always looking for equity. I'm trying to say, okay, if the house is worth, let's just say 100,000, what do I have to buy that house for by the time I renovate in order for that deal to make sense? So I'm always looking at the equity side of things first, right? So that's number one. And then I'm looking at the cash flow side if you're going to maintain and hold that property in perpetuity.
Great. And what is the price range that you are right now working with?
So I'm in 3 different markets. I'm in the Durham local market in 2 cities, and then I'm also a little bit east of Durham. So the price range is anywhere from the 400,000 to 600,000 mark in Durham, and then quite a bit lower in some of the eastern markets where housing prices just aren't the same as the GTA.
Okay. Is there any key, like the percentage? Let's say you are in the neighborhood that the prices are $500,000. Then, correct me if I'm wrong, you're looking for, let's say in that neighborhood, homes are usually selling for $500,000, that you are deducting a percentage to take it to your number. Let's say 10% lower than $500,000. That's what I'm looking at. Is that correct? Is that the way you do it?
Yeah, I do it a little bit differently. But I mean, in terms of, if we just use a flip for an example, if I buy a house and I know it's going to retail for about 500,000, I would expect to make about 10% on the back end on that flip. So, in order for that flip to make sense, I do this formula called the napkin number formula. And I've got 4 line items that I need to know, and that's renovation, carrying costs, construction costs, and some other things. And when I plug those into my formula,
That's the way it works.
On a house that's worth 500, maybe all done, fixed up, light renovation, you're probably buying that in around 320 to 350, somewhere in there.
Okay. And talking about carrying costs, what is the timing that you have for yourself typically?
I try to do a 6-month turn. So every property is different, obviously. So if it's a bigger reno, maybe it'll take longer. I just went through a 2-year renovation on a multifamily building. And I've done flips as quick as 3 weeks. So each property has its own nuances, but 1 month to 6 months is a pretty good estimate.
Great. And where did you get? I think someone.
Sorry, it's me, Lola. I've got a question actually for Ryan.
Sure, go ahead.
So you're saying like you hold the property while you renovate. So do you then get like a conventional mortgage, or do you get a private mortgage for that? Because obviously, are you going to pay the 500,000 down for the cost of the house and then the reno, or do you get a mortgage in the meantime while you renovate it?
I've done it both ways. So when I first got started, before I had too many properties for the bank to finance me, that's where I'm at now. I got too many houses. The bank would give me a conventional mortgage because it would debt service, and as long as it wasn't like burnt and crooked and moldy, they would probably finance a bit of a light fixer-upper, and that's pretty much what I was tackling at that point. So I've done it that way. I've also gone down the route of private financing, where you've got a private lender or a B lender or somebody that believes in your story right? That will lend you the capital to do the project. You're going to pay a little bit more, but you don't have to jump through the same hoops that you do with the bank. So I've gone about it both ways.
So then do you then get a construction mortgage then, a construction loan towards the house as well?
I've done that as well. So on some of the more substantial renovations where maybe it's a full gut or like a real full gut, back to the studs, back to the bricks from the inside, I've gone through the construction financing process, and you take that in draws. So for example, if your renovation is going to cost you $300,000, they'll typically do it in 3 draws. The first draw being 100,000, the second draw being 200,000, and the third being your final 300,000. The reason they do it like that is because of progress. The bank wants to see you making progress in those construction draws before they give you the next round of money, right? And with each draw, there's some legals and some holdbacks and stuff like that, but typically speaking, that's how construction financing works.
Okay, that's all. Thank you.
Welcome.
That was almost my question. Ryan, how do you get your monies?
How do I get my money? Like for what? For financing, or for what are we talking?
For next project, for purchasing a new project that you want to start mortgaging and then go after. Is it kind of, as Lola said, is it kind of coming from the same source? Are you using joint venture, using bank for mortgage and at the same time for the construction, or you use a private lender for construction costs?
Yeah, I've done all the above, truthfully. So, I mean, construction financing is great, like Lola and I just discussed. That has its place in the market. I've done private funds, just borrowing money and paying people interest, right? That's typically my favorite thing to do if I'm low on capital. So I'll borrow somebody's money, I will pay them monthly or as a lump sum installment at the end, and they give it back with the principal, obviously. I've done it through bank financing where you're putting the down payment and you're able to qualify with an A lender or a B lender. That's great too. I mean, I've done a number of different strategies depending on what that particular project will permit or what my financial capabilities are at that time. But like I say, private financing is great. Like being able to borrow money from people where they believe in your story and they know what you're doing and they can touch and see and smell and all that stuff. They can appreciate what you're doing, and people like to take part. Especially being a younger entrepreneur, I'm 33 now. People like to take part in those things. You know, it gives them the warm and fuzzies, and I like to take part with good people as well. So that's how I've operated in the past, and I continue to do so.
How many homes have you flipped so far?
We're over 50 properties.
Okay.
Yeah.
Okay. Any nightmare story you want to tell us?
Yeah. So I actually had a development deal that we were doing a couple of years ago. I just finished building the house recently, actually. So I bought the house in 2018. I knew that we were going to have some challenges going through the development process. So I said, okay, I'm going to put a tenant in this place just so it's buoyant, like just so it carries. Now, this was a bit of a fixer-upper. So you get the type of tenant that would only appreciate that type of a house. And the person that was in this house was just an absolute animal. He ripped the cabinets off the wall. He spray painted, he left garbage throughout the basement, like all kinds of just madness. So when he ripped the cabinets off the wall, then he stopped paying rent, and then he actually left. He fled the house. So I thought, God, this is ridiculous. I should be able to re-rent this house in a perfect world and continue carrying it until we're ready to build. So I called the police and I said, hello, police, please come to my house. I've been vandalized. And the police showed up. And they said, what happened? I told them, I said, tenants ripped the cabinets off the wall. They did all this stuff. And the police said, these were tenants. I said, yeah, they're tenants. And he goes, oh, we can't do anything about that. If they're tenants, they're under the Residential Tenancies Act. But if they didn't live here, then you could press charges. And I thought, oh my God, what kind of a world do we live in where somebody can damage somebody else's property, regardless of what's going to happen to that house in the end, right? And the police can't touch them. It blows my mind. So that was a horror story, I guess you could say. Fortunately, the house was coming down, so it didn't really matter in the end, but it did really tick me off.
You're still renting them if learning that story, or you leave them vacant as you do your?
Yeah, so I still do both. I mean, we got some developments that I'm going to leave vacant and just eat the carrying cost. And then we got some other ones that are going to be a longer term play. You know, maybe banking the land for a little bit because there's some upside in the future. So we'll rent those out.
Great. Ryan, as you know, there are different versions of real estate investment. One is buy and hold, the other one is flip. So why you like, or maybe you like buy and hold as well. So is that your strategy?
Yeah, buy and hold is definitely one of my strategies. I mean, I really enjoy the aspect and the appreciation of the buy and hold. We've been seeing really strong appreciation lately, especially in Durham. And I sat in a seminar this morning, and in the seminar, they talked about the appreciation in the last year, which was like 20 some odd percent. And then they talked about the appreciation since 2000 to today in the Durham region. And the average appreciation here, in particular Oshawa, was 7.3%, call it 7%, from 2000 to today. Like that's amazing. That's outpacing the average Ontario appreciation at 3 to 5%, right? So from that perspective, the buy and hold is great. Obviously, as the properties creep up in price, your cash flow becomes a little bit limited. You know, there's a cash flow crunch there, especially when you're leveraged. But as those mortgages start to come down and as the rents start to creep up, things rebalance themselves again if you have that long-term horizon.
Great. Question. If you, have you ever had a situation that you fix the property and then you put it on the market and it doesn't sell?
I've been there. Yeah, I've been there. I had a property, I guess it would have been about 3 years ago, that I overpaid on the way into the property. And I kind of knew it after I closed, and I didn't get the best advice. And I was going to take about a $90,000 loss. And I said to myself, okay, of all these deals that I'm doing, you know, I don't want to take a loss. What am I going to do? So I went plan B. I held the property for, I think it was a year. And then I did some other substantial renovations to make it a 2-unit home, which a lot of people do. I did it a little bit differently in the form of a coach house. So I was able to put a coach house in the backyard. Right. And by doing that, I was able to bump the rents and I was able to really evaluate the highest and best use in this case for this property, which was R1 zoning and 2 units in total.
Good. Going back to the topic of this webinar, highest and best use. You want to elaborate a little bit on that one?
Yeah. So highest and best use is something that I've really drilled down on in the last, we'll call it year or so, to the point that I said, okay, I'm going to put this in a book. Because of all these 50 some odd deals that I've done, the term highest and best use has come into play with each one. And highest and best use, in my opinion, is defined as the most profitable, productive, or efficient way to get something done somehow. And when I'm looking at real estate deals, like when we bring it back into the real estate and entrepreneur space, I'm looking at 3 things when I'm looking at deals. And that's what I talk about in the book. It's the highest and best use of the land, the best use of the structure, and the highest and best use of your own personal skill sets and time. And when we look at all 3 of these things, right, and really drill down on, okay, what am I going to do with this house? Or what am I personally good at? Or what's my family situation like? Some things boil up to the top, and that's how people know what to do with that property that's specific to their scenario.
Good. So this is the name of your book as well. So you want to tell us what we're going to see in that book and how we can get the book?
Yeah, for sure. So people can get the book at thehighestandbestuse.com. And you can sign up there. It's coming out Spring Market 2021. I think we're going to do it in print and Audible and all the different formats so people can get it on everything. But once we get that into production, inside the book, you're going to find out about those 3 things that I just mentioned. So highest and best use of the structure, the land, and your own skill sets and time. And then in each one of those 3 subcategories, I'm going to drill down on property specific examples. So for example, like just because somebody says that they can duplex a house, or just because somebody says that they can develop a piece of land, doesn't mean that that is the right strategy for that particular property or the right strategy for them. Right. So when I'm looking at these deals, sometimes it's about me and sometimes it's about others. So I'm going to go into some stories and some real life examples. And one of the things that I really preach is that I only talk about what I know, and I don't stray from that. So unless I've done it, I'm not going to be the guy to talk about it.
Great. And Ryan, do you do joint venture as well?
I used to do more than I do now. So of all those 50 some odd properties, I think maybe 6 of them have been JV. The rest have been my own. I'm more of a borrowing of private financing type of guy in this phase of my career.
In terms of having your crew, because you're a fixer-upper, do you have a set crew, or are you continuously hiring, and how does it work for you?
Yeah, so I typically run with between 8 and 15 open job sites at any one time. Those come in various phases. So some are active construction, some are in the pre-development, post-development phase. They vary. So right now, I think we have a handful of construction sites, which typically boil down to 2 or 3 full-time crews. Of that, I have about 4 to 6 full-time T4 employees that are on my team, and then we supplement with some of the other job sites with sub-trades and land planners and things like that as we require them.
And Ryan, do you buy these properties under your personal name, or you buy it under corporation, and it's all mixed?
It's mixed. I started off personal like most people do, and then when you grow, you realize, okay, the benefits of the corporation in scale actually make sense. Obviously, there's some legal liability that comes into play. That's really important. Loan to values, equity, family planning, things like that. Who's a shareholder? So all of those things become an equity once you start to grow.
Excellent. Ryan, what is your advice for the new beginners, newbies, want to get into fixer-upper? What do you suggest? Is there any strategy, number 1, 2, 3, that they should watch?
Yeah, I mean, if you want to get into a fixer-upper and flip it, I think that's great. You know, if you want to go in and you're doing your math right, and you understand construction, get in there, flip that thing and get out and make a few bucks and reset. You know, that's a good way to start for property number 1. If you want to do the buy and hold thing for property number 1, like I pretty much did for my first rental or my first investment, you can do that too. So, I mean, get in there, read lots of books, watch lots of YouTube, listen to lots of podcasts, you know, like yours, and anything that people want to do online now. I mean, you can do it really inexpensively. You don't need to spend $100,000 on a coach on day 1. You know, just get in there, read some free information, hit up Chapters Indigo, look on Amazon. There's a lot of resources that you can tackle before you actually dive in and make a mistake.
Excellent. Ryan, let's say this is your very first week you start fixing upper. What is that you would do differently?
Ooh, I don't know if I've ever been asked that. That's interesting. Man, sometimes it's so hard to think back to like deal number 1. What would I do differently? I think I would ask more questions. In 2012, in particular, the YouTube and education space in real estate wasn't the same online as it is today. So there was no mass amounts of podcasts that you could jump on, or there was no, you know, real YouTube specific to Canadian investors. There just wasn't that out there. So, I mean, you had to go to books, which was good, but I would probably read a few more books and actually spend the time at Chapters to learn what was in those books before jumping in. Not to say that what I did was wrong, because I don't think it was. Obviously, we're the sum of our experiences, and that's what's got me to here. But I think the learning curve would have been less if I had taken a little bit more time on the education piece.
I 100% agree. There are a lot of things. Sometimes I put myself, like the very first time I started some 16, 17 years ago, I had nothing but fear. Am I doing the right thing? Am I going to lose money? What? So I spent weeks working with Excel until one of the investors from Rain, Canada said, listen, buddy, just jump in, just go buy one. It's not the end of the world. And fortunately, I went through a lot of seminars and listened to a lot of CDs and talked to many other investors. Then, you know what? Someone hold my hand and jump into the pool. And that was the beginning. Once I tasted, it was much easier to mindset-wise to get into the second and third. I know I'm not going to lose anything. Mostly if you go with buy and hold. But you have to do your due diligence. You have to talk to so many people, to whoever does investment in the past. And as you said, going through all the seminars, reading books is very, very important. And as you said, it's on YouTube. Just go grab it. It's free.
I know. People are very fortunate now to be able to have that content at $0, at zero cost, and anytime they want. You know, the market's been ever forgiving. So if you bought anything in 2012, even if you really screwed up, I mean, short of buying something with an oil drum underneath the basement floor, I mean, you've probably come out fine, and more than fine by now, and you've probably doubled your money without having to know anything about real estate, just by owning that thing. You know, so in a rising market, it really covers up a lot of people's mistakes, which is good. Same thing goes for stocks or bonds or anything like that. Any of these markets that keep inflating really inflates the problems away, and it covers up maybe some mistakes that people have made in the past.
So Ryan, You thought anyone
Yeah,
said?
can I ask a question?
Sure, go
Ross,
ahead, Raj.
go ahead.
I mean, in case if people are talking about the crash, already the condo market is going down. So if anything happens over the next year or two, what can we do? How can we mitigate that? Any thoughts on that?
For the condo market specifically?
I mean, that's where the decrease might be more, but the same thing is applicable for other type of homes too, I believe.
Okay. So what I can do is tell you what I'm doing. I mean, I keep a couple of flips in the pipeline at all times. I'm big on buy and holds right now. So I do continue to acquire these buy and holds. What we're seeing in the Durham market is that people are fleeing the city of Toronto and they're coming out our way because for the same price as a, one bedroom, 500 square foot condo in the city, you can come out here and buy yourself a whole house with a backyard and parking. And with people working from home, they're seeing that lifestyle shift where it makes a little bit more sense. So I'm really drilling down on that. With respect to the condo market in Toronto, I'll preface by saying I don't invest in Toronto at all. So I'm not the condo guru. But what I do know is that for the most part, a lot of these condos don't cash flow and they're negative. And when you buy a condo knowing that that property is negative, hoping to just like break even or crush it with an Airbnb, you get into a situation like this where COVID's come in, there's no Airbnb, nobody's renting these things. And you get into a rental situation where there's lots of vacancy in a building and tenants have, 50 condos in a 500 unit building to choose from, which is deflationary on the rent prices, at least short term. So for me, I make sure that the cash flow fundamentals are there. I make sure that the long-term equity will be there if it's a buy and hold property. And I really try to stay away from anything that's negative cash flow.
Okay.
Does that help?
I mean, if you happen to hold on to something which you made a decision, let's say this year or last year, but then if the market is going down, what can you do to mitigate, or is it better to just hold on to it until it comes back, or what can we do?
Yeah, so I mean, we saw a little bit of this in 2017 where the market fell off a bit and then came back. And then we saw a little bit of this in whenever COVID came in, March, April this year. The market came off a little bit and then people were staying home and they weren't buying things. And then it came back. And I'm not saying that it will always come back because that would be speculatory. However, what I am saying is we are printing money, right, in mass quantities. Generally speaking, we have the same amount or way more dollars chasing the same amount of goods, which is inflationary. We have a net migration coming into the GTA of 100, 120, 140,000 people per year. And that has no intention on stopping for the next number of years. I think they're projecting it to like 2046 or something. That was a government stat, but you'd have to confirm that to be sure. We also can't keep up with the pace of housing that we're actually required to have in order to house all these people that are coming in. So, I mean, all of these things with principles of supply and demand are very favorable in terms of inflationary pricing for condos or for any living situation at all. So I'm in it for the long term for the most part. If it's a flip, I know my financing and I know my numbers and everything is set up accordingly. But for me, I'm in it for the long term. And I think that we will see over the long term, I think that we will see some appreciation. In the short term, you will always get cycles. So again, if your property cash flows and you can afford to carry it vacant for a couple months or negative cash flow for however long you want to do that, I think you'll be okay. But again, you got to really do what's right for you.
Okay, thank you.
Excellent. Just adding to what Ryan said, whenever you buy, and that's the most important part of real estate investment, most talking about condos. First of all, do not get emotional. Do not follow the hype that the marketing companies put in there for that condo. Also look at the supply and demand. Always look at the transportation. That's very, very important. A condo that is sitting on top of a subway compared to a condo that is far away is no brainer. You can easily pick the right one. And always look at the stats and information that can support your investment. Remember, it's big money, is you taking the chance, and the whole idea is not to become a real estate investor, but to make money at the end of the day. So you have to take it very, very seriously, and you really have to do your due diligence. listen, you go to buy a car, you spend half an hour, maybe a few hours checking the car. With that amount of money, now you're buying a big investment. It's worth it for you to really invest your time, find out, sit down with some real estate investors, some real estate agents that they are doing this kind of things, talk to a lawyer if it's necessary, and make sure your purchase is the right purchase. But then once you buy it, is it the right time to sell it? So don't panic with all these newses that say the market would crash, etc. Just read between the lines and rely on the stats. Like for COVID-19, they said the market would crash. It never crashed. It actually 1/4 of all the transactions were multiple offers. So you really have to rely on numbers. And that's what a savvy investor does compared to listening to radio and news and friends and families. Don't do it, do this, and those kind of things. So that's very crucial that don't play game with your money.
I think too, for Raj, something that would be important would be to think like a business person, not just a real estate investor. Obviously we're all very involved in the real estate space, but you need to put on your entrepreneur's hat. You need to put on your business owner hat and say, okay, is this the highest and best use of my money or my time, depending on how much time or how much money you spent on that deal? What is it returning me? Am I happy with that return? For a lot of people, if they're losing 20% year over year and the return that somebody else has is just breaking even, well, all of a sudden a 0% return when you benchmark it like that is amazing because you're actually ahead of the market by 20%, even though you're not ahead of yourself, right? Conversely, if your investment could be making you 20% return year over year and everybody else is making 0, you really got to benchmark that and say, okay, is this worth my time? So highest and best use of your funds is also as important in this equation.
Excellent. Thank you very much, Ryan. Ryan, tell us a little bit of your next project. It seems you're handling bigger and bigger projects. Tell us where you're going, your plan for next few years.
Yeah, so between now and 2022, heavily focused on either extensive renovations, so larger projects, or new infill development in the low-rise apartment building space. So I think next year, over the next couple of years, we've got 5 or 6 low-rise apartment buildings to construct. All except for one are mine in full ownership. So we got that coming down the pipe, and then we got a couple infill builds like duplexes and stuff like that from the land that I had recently severed. So that's coming up, and then some extensive renos. So if I can move my staff in for 3 to 6 months into a project, it saves a lot of the logistics. So we have a few of those coming up as well, and all of which turn into a pretty full schedule and a pretty great next couple of years. So I'm really excited for it.
Excellent. If there's, it doesn't seem there is anyone with any other question.
You mentioned about coach house. I'm not pretty familiar with that. Can you give me some info on that?
Absolutely. So a coach house historically would be considered something similar to a detached garage in behind a main principal dwelling. And in that detached garage, there would be living quarters. So like a kitchen, a bathroom, 1 or 2 bedrooms, something like this. That's becoming more and more popular. That's a new trend in the residential real estate space, particularly west of the city and very far east of the city, but not so much in the like the East Durham area. It's not as prevalent right now, but it is coming. You hear it more commonly in Toronto called the laneway house, or out in Hamilton, they're called laneway houses, or people have different names for it, but just know that it's typically a detached structure in the rear yard behind the principal building, and there's living quarters within it.
So is it different between different municipalities whether they do allow such houses? And if they do allow, then how much of a space do we need in the backyard to construct such a house?
Yeah, so every town is different for sure. It comes down to something that's called the zoning bylaw. And I'm actually talking about that in the book, is how to read a zoning bylaw and why that's so important. Zoning is a critical point because the zoning bylaw dictates what that land is valued for and what you can actually do with the dirt. And in something like a coach house, if you don't have zoning that's favorable, it's going to be very difficult for you to go up against City Hall and prove your case as to why you feel you should do something that the zoning bylaw doesn't permit. So in the case of, I believe Guelph permits them, I think Trenton permits them. I think a lot of small subsidiary towns in Ontario do permit them. In the case of some of those places, you walk in and say, I want to build a coach house. And they're like, yeah, that's great. Go ahead and do it. But then you go into some of the other cities and they don't permit that at all. And they say, no, we don't want that in our town. We prefer a basement apartment. So there you would say, okay, rather than a coach house, let's do the basement suite. And then you move forward that way. It's all about getting density on the parcel and really maximizing how much income you can generate from whatever it is you're allowed to do with that dirt.
Okay.
So, anyone else with any question?
Sorry, Ryan, do you know the coach houses, are they also called the in-law suites?
In-law suites are typically like a basement apartment or a second floor loft or something like that. Coach houses would be a separate structure altogether, but very similar in concept.
Okay. And then one other question I was going to ask was, with your reno work, have you done like the multifamily homes, so like changing a single income property into like a duplex, like a multifamily home type of thing? And how much do you reckon, in your experience, would you roughly think of spending on it? If that makes sense.
Yeah, it makes sense. So if you take your typical cookie cutter 2 or 3 bed bungalow, with an unfinished basement, you could spend $100,000 in the basement without blinking an eye, 50 to 100 grand, no problem. I guess that would be a rough ballpark without knowing the specifics of the property and how big and how many square feet and so on. 50 to 100K is a pretty good starting point. You're going to spend a little bit more upstairs, maybe to clean it up and paint the cabinets or do whatever you have to do. So, I mean, that's a range that you could start in. In terms of multifamily, yep, I've done some multifamily conversions as well. Again, it's all the same stuff: kitchens and bath and flooring and paint. You just scale up the idea and scale up the renovation budget and scale up the time.
Okay, thank you.
Excellent. Thank you very much, Ryan, for coming up on this Wednesday webinar. It was great to have you here, and thank you for sharing with us your precious experience, and that's worth a lot to us. I appreciate coming.
Great. Thank you for having me on.
Yeah, take care. Bye.